My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. People, my friends, I'm just trying to make a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You can't always figure out what a stock is worth. When something is in free fall, as so many tech stocks were today, although the rest of the market's pretty solid, Dow gaining 195 points, S&P advancing 0.17%, while the Nasdaq lost 0.50%, you have to figure out what can bottom first. But not many beaten down stocks feel like they're hitting terra firma now, do they? So why don't we take a hard look at what's getting hit so we can make some determinations, even as I say, you can't necessarily prove when exactly a stock can bottom. Now, for starters, on the last day, the president, the Federal Reserve chairman, the Fed vice chair, the Treasury secretary, they've all come out and said they're worried about inflation. Treasury yields have gone back up, too. In that environment, money managers want to pay less for all stocks, but particularly the most expensive ones. Don't sweat this part, though. We've seen it before, and it's usually just a piece of the puzzle, not the puzzle itself. But all this hand-wringing about inflation makes it hard to guess where stocks deserve to be trading. And I say guess because that's really all we can do. So let's talk about what's getting hit here, all right? Let's understand the parameters and the players. First, coming this week, many of the so-called high flyers were really and truly trading at nosebleed levels. Now, some of these were absolutely ridiculous, courtesy of what we call parabolic moves, like a straight line higher before the whole thing implodes. That includes most of the cybersecurity stocks, the cloud stocks, the hyperscale stocks, and the electric vehicle plays. These are all companies that are doing incredibly well. However, their stocks have many acolytes, which means their share prices often get pushed up and up and up, not on different news, but on the same news. Next up are the stocks of companies that are doing pretty well, but are also being challenged by competition that could reduce their future earnings. None of these companies will admit that they're headed for a price war, but Wall Street seemed to know something that we don't, and that led to some aggressive selling over the last couple of days. Then there's the third group, which includes some non-Nasdaq stocks. These are the ones with great earnings reports, but they've also signaled, wittingly or unwittingly, that there's a slowdown ahead. Again, subtly or not so subtly, and we had two of those today. Best Buy and Dick's. They are sending shivers up the spines of investors who expected nothing but big beat, big raise. They didn't get that raise guidance for the fourth quarter they were looking for. They got some, but not enough. Final group of victims, oh boy, these are the companies where the numbers, frankly, are, let's call them murky, and there seems to be no way to find your footing. There are a ton of these, including some highly visible ne'er-do-wells that we have to mention. We have to show some wrath here. All right, let's throw one more complication, okay? All of these stocks have terrible charts, especially after they pirouetted down yesterday, opening up big, then getting mauled and finishing much lower. You know what? I call that the kiss of death chart. Some people call it an island reversal. So why don't we circle back to the first group of victims here, the red hots, as I call them. These are companies that did absolutely nothing wrong, nothing. There's nothing. Every one of these companies did better than expected. They reported better than expected results, top and bottom, forecasted higher growth, and yet their stocks are still getting crushed this week. That's not supposed to happen, right? Alphabet, Microsoft, Cloudflare, Palo Alto Networks, Roblox, AMD, Nvidia. We've had them all. They are all doing fantastically. I won't mince words. These are the names you want to buy first. I've studied these tech-led sell-offs multiple times over the last 40 years, and these best-of-breed stocks tend to bottom before all the others. Amazingly, almost every time these high multiple stocks sell off, the fall lasts for 3 days, 3 days from the start. And then they begin to flatline before powering higher again, as if nothing really happened except for a shakeout of the weak hands and a recharge. It's a little trickery of the holiday, but these high flyers should be putting in bottoms by Friday. I know, it seems so pat, but that's been the pattern. Next up, the ones that have done well. They've done well, but could be facing a ton of competition, phantom or otherwise. Consider the payment stocks. I'm talking Visa, MasterCard, Square, PayPal. These, I like to look at them through these glasses. But I can't look at them through rose-colored glasses. It'll just cost too much money. Now, these stocks just act horrendously. And I think that's going to continue until there's an absolute total shakeout. Each time you feel like you're getting at bottom, it turns out they can go still lower. That's been very evident since MasterCard held its fabulous analyst day 2 weeks ago, and Square reported what I thought was a solid quarter. It didn't matter. You have some truly terrific companies here. These are great companies, okay? We're not judging the companies, but they're in trouble in terms of the stock because they are being competed against by new companies. Here I'm talking about companies like Affirm, companies like Upstart, the fintech, new fintech, let's call it that, and NFT, or something that causes the bank stocks to stop rallying. Because remember, as the bank stocks go up, these go down. It's the other pattern had been most of the year. Remember, financial technology almost never works when the regular financials are roaring. The payment stocks need long-term interest rates to come back down, and they need to give you some kind of internal catalyst, either a big buyback or surprising acceleration in earnings growth or some sort of reorganization. Now, it's very, very difficult, which is why the payment stocks have become dangerous. Historically, this group had high-priced earnings multiples. It was completely loved. It was precisely because why? They had such limited competition. If that's changing, then they have a problem, especially PayPal, which my charitable trust owns. Now, you got to take the bad with the good, as I tell investment club members all the time, because you learn a lot more from the weak ones than the stronger ones. And boy, weak ones, if you Google weak stock, well, don't, because what happens is it comes up with PayPal. My advice here, take your time with the competitively challenged stocks. Let the sellers exhaust themselves. Until we get something better happening at the underlying companies, you could have some tough slogging ahead. Don't be fooled by one day where it doesn't go down or it goes up just a little. It doesn't help that we keep being flooded, by the way, with fintech IPOs. I'm not saying you have to abandon these, but if you want to stick with the group, you need to be patient and wait for 3 or 4 days that they bottom, not one. Third group, the companies that crushed the estimates but then gave you some reason to believe that, well, let's say, to feel downbeat about the future. And it may have been intentional or it may not have been. It may have been by mistake. Best Buy and Dick's Sporting Goods, they got hit by the ugly stick today. Walmart got mashed by it last week. I think all these companies were simply being conservative and their forecasts were taken totally out of context, and they are doing really well. Still, you have to respect the skepticism from people who believe that the best is now behind them. Walmart has given us a glimpse of how these stocks can form a bottom. It took a full 5 days to ensure that you have firm footing. Then the stock started crawling back. That said, it'll be hard for these names to take out their highs. I expect them to get hit again. Now, we own some Walmart for the Charitable Trust, as club members know. But if Walmart gets back to where it was trading before, we might have to ring the register. Too many question marks. How about that? Too many question marks. Finally, they're the most problematic ones. And now I'm talking about, oh, man, Disney, Twilio, Zoom. Companies that disappointed Wall Street with franchises that are starting to look tired at best. Here, without some news, maybe an acquisition, maybe some kind of breakup, anything to put the near-term past behind them, I don't expect much positives until they report again. And that's what might change the course, the trajectory. Now, that may be too long for some of you. But these stocks are now in the penalty box. They've got like 50-minute measures. And that's how the penalty box works. The toughest thing, it's probably too late to sell any of these beaten down stocks. That doesn't necessarily make them compelling. When you hear that a stock is done going down, that does not mean you should buy. Now, I am conscious after spending time with Jensen Huang, the visionary CEO of Nvidia last week, that everything I just said is indeed guesswork. None of my knowledge is like his. I'm not a physicist of stocks. However, I am someone who's been knocked around a lot. Just like members of the investment club, I'm a pattern recognizer who's aware that patterns don't always obey the laws of nature. But the bottom line, these historical patterns are pretty darn good approximations. And I've been through enough of these tech sell-offs or the tech-led sell-offs to get a sense of how they normally play out. And remember, in these kinds of sell-offs, patience in this business is actually still a virtue.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.